Hi, everybody, and welcome. My name is Louise Marfan. I'm the Director of Financial Sector Standards here at Share Action, and we are really delighted that you can join us during London Climate Action Week for this webinar. And the purpose of today's event is to explore the issues raised in our recently published guidance paper, Undermining Transition, Risk and Capital. This is the third paper in Share Action's RISE series, which, as you can see on your screens, stands for Responsible Investment Standards and Expectations. It's a series of guidance for asset managers setting out the practical actions we believe that they can and should take to be truly responsible investors. And we shared on the screen our definition of responsible investment, which is a transparent approach embedded throughout the investment process that takes the negative and positive impacts on people and planet as seriously as financial risk and return. And the third paper we're going to talk about today is about fossil fuel. I think we're all seeing news stories about the social environmental impacts of climate change all around us every day. But what's also becoming increasingly clear is that climate change is a growing economic and financial concern. And unfortunately, the strategies of fossil fuel companies currently represent a threat to transition and are increasing those economic and financial risks. And in light of the increasing evidence of those risks, we believe that investors have a strong motive to use their influence to turn those strategies around. And we also believe that investors, if they're robust and ambitious in their approach, can have a really powerful influence. But we're not using that effectively enough right now. And that's why we published this paper, which we believe provides a practical blueprint for investors to step up their ambition. So that's a little bit of context of why we produced the guidance and what it aims to achieve and what we want to talk to you about today. Looking forward to a really stimulating conversation. And I'm really delighted to have three great speakers with us to get the conversation started. So first, we're going to hear from Oliver Bettis. Oliver is a council member of the Institute and Faculty of Actuaries, and he was one of the authors of the highly influential Climate Scorpion paper, which demonstrates how the risks of climate are being underestimated and underprepared for. And then we're going to hear from Maeve O'Connor. She's an analyst in Carbon Tracker's oil, gas and mining team. Maeve has written reports on the failure of fossil fuel companies to align their strategies to the requirements of transition. So she's brilliantly well placed to set the scene for us on where the sector's at and where it needs to get to. And finally, we'll turn to Neil Considine. He's the head of investor standards here at Share Action and the lead author of our report. He's going to take us through our key arguments and recommendations from the paper. So we're looking forward to a really good discussion. But before we dive in, just a little bit of housekeeping for you. We hope we've left plenty of time for Q&A after the presentations. Do please feel free to submit your questions using the Q&A function in Zoom anytime you like. As I say, we hope for lots of questions. So if we don't get time to answer them all, we will follow up on email. And just so you're aware, the webinar is being recorded and we will circulate a link after the session. So with all the preliminaries out of the way, I will now pass over to Oliver to set the scene on the economic risks. Thanks, Oliver.
Thanks very much, Louise. So I'm going to talk for a few minutes about the Climate Scorpion report that was published in March by Institute of Faculty of Actuaries, my professional body. So this was a collaboration between a group of actuaries and scientists, including Professor Tim Lenton at Exeter University, who's well-known expert on tipping points. So I'm going to talk about a few of the findings from the report. The first one is just taking a look at the recent temperature record. So it's a natural thing for actuaries to do. This is an experience analysis. So this data is actually taken from Copernicus, the EU website. And what it shows is the complete temperature record, monthly temperatures from 1940 until today. So you can see the clear trend and the temperature anomaly from naught and then going up to the picture today, which is the red line, the last 12 months. So you can see that there's been an acceleration in warming. And actually, the average temperature anomaly in the last 12-month period was 1.6 degrees above pre-industrial. So that's above the 1.5 degree limit. Now, part of that increase will be down to, it was an El Nino year, 2023. And so that's now coming down to the temperature recently coming down. It will come down further. But that doesn't explain all. It wasn't a particularly strong El Nino, and it doesn't explain all the temperature rise. There's discussion about this, whether it's aerosols, but the general point is that the picture's looking worse than previously thought as regards temperature. Next slide, please. So as the Earth warms, of course, extreme weather events become more frequent and more damaging. And this map's from Carbon Brief, and it shows past weather events with information about the size of losses. So there's more than 400 peer-reviewed studies looking at weather extremes around the world, wildfires in the US, heat waves in India and Pakistan. So there's mounting evidence that human activity is already raising the risk from extreme weather. Next slide, please. And then when you get to higher degrees of warming, so above 1.5 degrees, there's a reason why this was picked as being a safe limit. And that's one of the reasons is because of tipping points. So the science on this has developed in recent years, and it's now known that actually tipping points may be triggered at a lower temperature than previously thought, possibly not much above 1.5 degrees. Now this map shows, and also there are more tipping points that have been found, and this map shows some of them. So for example, the Greenland ice sheet is one of the ones that we're closest to tipping. So these are potentially irreversible effects. And also they interact with each other, make each other more likely, which just adds to the knowledge that the risk of staying above 1.5 degrees is quite extreme. Next slide, please. So the Climate Scorpion report looks at 4 specific risks in a bit more detail. They're listed there on the slide. But particularly it looks at the interrelation of risks and how they cascade and compound with each other. And of course, that increases the total risk. If you don't take into account the interactions of risks, you don't get the full picture. So for example, the climate change increases risk from extreme heat stress, but if you have conflicts arising from climate-related causes, that will reduce ability to respond to a heat stress event. Next slide, please. And then, so this diagram is taken or adapted from the World Economic Forum Global Risk Perception Survey. So it shows the interconnection of risks and how that multiplies the impact on society. And then you've got the effect of that. As you get to the extreme, there's something called derailment risk, which I think is quite a useful term. And what that means is that as you get more damage from climate causes, you get more effort and energy diverted to basically rebuilding and taking care of the damage that's occurred, which may detract from efforts to decarbonize the economy and actually get onto a sustainable path. So that's something that to be aware of. Next slide, please. Okay. And then one of the other findings was about the what we call the sting in the tail. So this diagram sort of looks like spaghetti. It's basically probability distribution functions for climate sensitivity, meaning, so climate sensitivity is the estimation from the IPCC of the amount of warming that you get if you double carbon dioxide level. So it's like a measure of the sensitivity of the climate to greenhouse gas the best estimate that the IPCC give and have given for a long time is 3 degrees Celsius to double CO2. But there's a lot of uncertainty in that number, as shown by the different probability distributions, and actually there's an 18% chance of the climate sensitivity being more than 4.5 degrees Celsius, which is more than 1 in 6. It's higher probability than Russian roulette. So it's a bit of a sobering thought. Next slide, please. And then there's one other element of uncertainty, which is relating to the damage caused by climate change. Now, this is actually from Carbon Tracker, and it was referenced in their previous report, the Emperor's New Climate Scenarios, as well as Climate Scorpion, because it's such a key point here. So in order to estimate global damages from climate change, the IPCC and others do this, you need a damage function which relates temperature rise to the amount of GDP loss. And that's what this chart shows. So temperature rise from 0 to 5 degrees of warming. And then on the y-axis, you've got damages as a percent of global GDP. And then the lower blue line, labeled quadratic, is the normal extrapolation that's done to try and estimate GDP loss at higher degrees of warming. That's used in pretty much all climate scenarios throughout the financial sector. But if you talk to climate scientists, then they'll immediately say, well, it's not realistic. You look at 5 degrees of warming, you get about 10% GDP loss. It just doesn't add up. You get really, really big changes of the climate, where you can grow food, zones of vegetation, and so on, places where people can live. So more realistic functions are S-shaped logistic functions. We don't know exactly what the parameters are, but you basically just need to sort of have a guess at what level of warming would cause, say, 80% of GDP loss. At what level? Maybe that's 4 degrees, maybe it's 3 degrees, something like that. That is a much more realistic way of looking at the overall climate damage, because it allows the possibility of global ruin. Okay, next slide, please. So all of this kind of adds up to the message that going and staying above 1.5 degrees is extremely risky. It's unacceptable risk. So the IPCC, so this chart is actually from the IPCC 2018 special report on 1.5 degrees. And what it shows is the emission pathways that we need to have. Obviously, this is a few years old now. This is the emission pathways we need to have to get under 1.5 degrees. So you need extremely rapid emission cuts to mid-century, and then in the second half of this century, you need massive negative emissions, taking CO2 out of the air. And this leads to implications for financial services firms, which means maybe a need to revisit carbon budgets and other assumptions, moving away from temperature commitments, focusing on how do you support decarbonisation in the real world, and how do you support policy action to accelerate positive tipping points. Next slide, please. And that leads on to my last slide, which is about the opportunities for positive action, because the climate is a complex system, but so is the economy. And what that means is there may be opportunity to change the economy, accelerate the energy transition, much more than is usually realized. So you can have positive feedback, like beneficial feedback loops in the economy with the right policies. And that's, I think, good message to start there.
Oliver, thank you so much for that sobering exposition of the potential economic impact, but also the reminder that there is potential upside not just for the planet, but also for the economy in the transition. Yeah, thank you so much for that. I'm sure we'll get lots and lots of questions, but I'm going to move us on now to Maeve to funnel us in a little bit towards the fossil fuel sector and where they're at and how they are currently contributing to this situation. Over to you, Maeve. Thank you.
Thanks, Louise, and Oliver, indeed. So, yes, I'll be giving a bit of an overview of our assessments of the climate or Paris alignment of the oil and gas industry as it stands. And I'd start by saying that the fossil fuel industry is somewhat unique in the actions that are required of it to achieve alignment with the Paris goals. So for most sectors of the economy, climate alignment is really about reducing the amount of emissions per unit of output. So how do we make the same amount of widgets, but with fewer emissions associated with the process? But for the oil and gas sector, it's different because you cannot decarbonize fossil fuels. And because of the industry's outsized contribution to fossil fuels, outside contribution to global emissions, mitigating temperature warming will require a drastic reduction in the amount of fossil fuels that we use. And so to put that another way, if we go to the next slide, please. There is very limited room for new oil and gas projects under a Paris-aligned scenario. And it's abundantly clear that there's no new oil and gas projects are compatible with the 1.5 degree scenario. So you can see in the chart there in the grey, future supply from projects which are already producing, and that supply meets demand under a 1.5. Even under a looser interpretation of Paris, so a 1.7 or a 1.65, there is still very limited space for new oil and gas projects. And so what does that mean for fossil fuel producers and their alignment with Paris? If we go to the next slide, please. Well, it ultimately means that production will need to fall over time. And if a company is to be aligned with Paris. So when we assess alignment, we really base our assessments on the level of new developments that a company is planning on. And there are a couple of different metrics that we've developed to help investors ascertain the extent to which a company may be planning on or capable or planning on increasing production or capable of increasing production. So we have developed what we are calling our combined alignment assessment, and based off these various metrics to give investors a holistic overview of multiple aspects of oil and gas companies, their portfolios, targets, and potential production plans. And this assessment was published recently in March in a paper that we put out called Paris Malign 2, which you can download there via the QR code if you're curious. So our first metric, next slide, please, looks at unsanctioned investments. So companies' unsanctioned investments. So really what is the suite of project options that is available to a company that they could potentially develop? And crucially, what temperature warming scenario are those projects aligned with? Now the methodology behind this analysis is available in the report, so I'd encourage you to have a look if you're curious. But this chart here shows the proportion of each company's portfolios which are compatible with various temperature warming scenarios. So to the left, we have the more aligned producers, which include the NOCs. So you have Saudi Aramco, Sinopec, CNOOC, as well as Eni. And then to the right, with the large red bars, are those producers which have project options which are more so aligned with the 2.4 degree scenario. So those include the shale producers and also the more shale focused majors. It's also worth noting that companies certainly do have project options which are not aligned or incompatible even with the 2.4 degree scenario. And those are captured by the dark blue bars at the top. And while those projects are potentially less likely to be sanctioned, given that they tend to be much higher cost, we do find that such projects are still being sanctioned. And they, of course, are even less aligned than those in the red bars. If we go to the next slide to move on to our second metric. So of course, if we're talking about production, it's natural enough to look at the company's own production guidance. So we looked into production guidance to ascertain kind of which are kind of outwardly targeting growth, and the answer really is most of them. So among the 25 companies here, almost all are targeting some form of growth, be it in the longer term. For example, Conoco, well, longer term production guidance tends only to go out as far as 2030, so it's really kind of the medium term. But ConocoPhillips, for example, are targeting a 47% increase in production by 2032. Others are publishing guidance indicating that they intend to increase production, but more so in the near term. There are a couple, Repsol, Shell, and Equinor, you can see in the kind of grey highlighted cells there, that are aiming to keep production flat in absolute terms out to the kind of mid-2020s or to 2030. But really, it's only BP that we find are targeting a longer-term reduction in growth, which would make them kind of the most aligned on this metric. And so if we go to the next slide, please, we've seen future investments and production plans. But there are a couple of other areas that we look at to kind of give a more holistic view of a company's Paris alignment. This includes recent project sanctions. So what kind of developments has a company been sanctioning in the last 2 years or so? And we found that companies, as I kind of alluded to earlier, are sanctioning projects which are incompatible with even a 2.4 degree world. And those include Total Energies and CNOOC's large expansion into Uganda, as well as Equinor's Munin project in Norway, and one of Eni's projects off the Ivory Coast. And we also incorporate emissions targets in, and we have developed a series of reports called Absolute Impact, in which we assess the alignment of specifically company emissions targets. And so we have developed what we call our hallmarks of Paris aligned emissions targets, and kind of rank them in this assessment based off to what extent they meet those hallmarks. As you can kind of see in the chart there, 16, I think, of the 25 companies fall in the red band, and that's largely due to the fact that the companies don't include Scope 3 emissions in their targets. And our fifth and final metric is around executive remuneration incentives. So this we see as kind of an important governance factor, because it really kind of indicates to what extent the C-suite of a company is being incentivized to grow production. And they can be those kind of incentives can be done directly or indirectly. So we scored each company based on those 5 metrics. And if we go to the next slide, we can see the results of our combined alignment assessment. So we weighted the individual scores based on the kind of relative importance for what we consider the relative importance for Paris alignment. And you can really see that, well, the potential grades went from A to H. The best performing company, BP, scored a D. So you can really see that the results show that the industry is far from where it needs to be in order to be considered aligned with the goals of the Paris Agreement. Though within that, there are kind of leaders and laggards. BP, as I mentioned, tops the ranking with a D due to, in part, to its target to cut production out to 2030. But there are aspects, some interesting instances of where companies score well on some metrics and less well on others. Eni, for example, have what we see as kind of the most ambitious emissions target of the cohort, but it falls down as it still incentivizes its executives to grow production, and it also has a target to increase production in the medium term. Aramco and indeed the other NOCs benefit from the fact that their future investments are generally kind of more aligned with APS or a 1.7 degree scenario, but ultimately score poorly across our other metrics. And so that is kind of our assessment of the state of the industry. And I will spend a little bit of time talking about the kind of strategies that we see face the oil and gas companies, or that we see oil and gas companies have in the face of the energy transition, and how they may affect a company's alignment or lack thereof. So we explored these in a report we put out last year called Navigating Peak Demand. And ultimately, we see that the kind of top line strategic choice for oil and gas companies is around upstream production and development. So are you expanding or are you kind of contracting production? And within that, there's kind of a scale, as you can see. So if you're to pursue a strategy of no further development, you could do that via either an accelerated decline or via natural depletion as the assets themselves run dry. Or indeed, you could increase production at various levels of growth, either be it managed or kind of just replacement, or indeed a pure growth strategy. And I would say that you can look at these strategies in terms of their alignment as an accelerated decline being kind of likely the most aligned, whereas a strategy of growth, the kind of least aligned. And what I would say, if we go to the next slide, please. I think often when we talk about fossil fuel companies and their alignment, we hear about them, diversifying into becoming renewable energy companies, and that's kind of where the companies will find their place in a Paris-aligned world. And yet that may be true, but what I would emphasize here and kind of leave you with is that the kind of top line strategy there of development, no further development or continued development is really what's key for these companies to achieve alignment with the Paris goals. And then what they do with the capital that they would have historically reinvested in growing production could be to return the capital to shareholders via dividends or buybacks. We've seen the industry doing a lot of that recently. Or indeed, they could invest in new businesses, be it renewables or decarbonization as a service. But crucially, those kind of investments in new businesses do not necessarily make a company more aligned with the Paris Agreement. It's really the upstream and production and development plans that will determine that. And so I'd leave you with a few key takeaways on the last slide, just to sum up. So, yeah, investors seeking Paris-aligned portfolios cannot credibly invest in companies which are themselves not Paris-aligned. And that analysis of investment and production plans are really crucial to determining an oil company's climate alignment. Our assessment finds that companies are still far from Paris-aligned, though some more so than others. And lastly, that production declines are really the prerequisite for Paris alignment, but not necessarily diversification. Thank you.
Thank you for that, and for summarising those key takeaways so clearly there for us. Again, sobering to see how much there is to do, but it seems like your work is a fantastic resource for investors who are looking to try and drive us all in the right direction. And so with that, I'm going to introduce Neil Considine, who's the author of the paper we're here to talk about today, and to tell us a little bit more about how we think investors can do that. So Neil, take it away.
Great, thanks, Louise, and thanks everyone for joining us today. So Oliver's provided a compelling articulation of the urgency of addressing climate change and transitioning away from a fossil fuel economy. And Maeve has given a really clear picture of how fossil fuel companies have yet to adjust their strategies to the reality of transition. So what does that mean for investors and what can they do about it? Well, in this section, I'm going to cover three things. I'll talk about why the playbook of patient engagement and broad investment in the fossil fuel sector needs to change. I'll then challenge some of the arguments we hear from investors for why they don't adopt a more robust approach. And finally, I'll outline a more purposeful blueprint to investing in and stewarding the fossil fuel sector to influence it towards aligning with transition. So why do we think the current playbook needs to be urgently changed? Well, we've heard from Oliver that climate change isn't just a matter of environmental and social concern, but that realistic damage functions mean anything above 1.5 degrees is also a matter of very material economic concern. And that creates a clear financial motive for investors to apply their significant potential influence to limit even incremental temperature rises. That financial motive directs investor attention to fossil fuel companies. To limit temperature rises, we need to reduce the production of fossil fuels. And it's important to stress that transition is, as Maeve has highlighted, fundamentally different for fossil fuel companies than other companies with a high carbon footprint. Transition for those other companies means changing their means of production, the source of energy they consume and their raw material inputs. Transition for the fossil fuel sector means changing their product. And that is far more challenging. Put simply, the sector has the most to lose from transition. And it's therefore incentivized to resist transition. And whether that's through what US Congressman Jamie Raskin recently described as seeking to confuse and mislead the public while working unceasingly to lock down a fossil fuel future, or through lobbying against transition, etc. And that resistance has implications for the effectiveness that can be reasonably expected from a traditional patient stewardship approach. Moreover, fossil fuel companies have the potential to disrupt transition. As we've heard from Maeve, the fossil fuel sector is currently a long way from being aligned with the kind of transition we need to see. And that isn't just a bet by the sector against transition. It actually makes transition itself less likely to succeed at the pace we need. Well, why is that? An optimally efficient transition would require all available renewable capacity and clean feedstocks being utilized. As renewable capacity grows, fossil fuel production can reduce. But if the fossil fuel sector overproduces, it'll be competing with transition. And furthermore, as well as leaving clean capacity idle, overproduction may put short-term pressure on energy prices, reducing the incentive to invest in new renewable capacity. So we think investors should reflect these risks to transition posed by the fossil fuel sector's growth and expansion plans through robust policies that include investment restrictions and voting. Yet the current investment restrictions are pretty limited in scope. 21 of the 25 asset managers we looked at for this report had restrictions on coal, but only 2 of those applied the restrictions across all funds. 18 applied restrictions on unconventional oil and gas, and 9 on conventional oil and gas, but none of those were applied across all funds. Turning to voting, the 30 shareholder resolutions at energy companies that we looked at in our 2023 Voting Matters report received just 23% support on average. That's down from 30% in 2022. So in our view, this combination of limited investment restrictions and low support for resolutions translates into a missed opportunity to send a clear message to fossil fuel companies that investors want them to align to transition. The potential influence of investors is being underused. So why is that? Well, in the report, we address various arguments that we hear from asset managers against adopting a more robust approach, and I'll touch on 3 of those here. One argument is that the global economy depends on energy, and fossil fuel companies are just meeting that demand for energy. But transition isn't about leaving demand unmet, but rather about how demand is met. Transition means increasingly meeting demand through renewable sources combined with delivering energy efficiencies. 2023 saw 510 gigawatts of new renewable energy capacity. That's nearly 50% more than was added in 2022. And that exponential growth is being driven by the rapid decline in clean energy costs. As the rate of renewable capacity additions increases each year, it can meet more of that growth in total energy demand, reducing our dependence on fossil fuel production. And yet, fossil fuel companies aren't planning to reduce production. They're planning to either keep it stable in a few cases or grow it over the coming years. In fact, the IEA recently highlighted a surge in global oil production capacity is expected to outstrip demand growth between now and 2030 by a staggering 8 million barrels per day. And the sector spending $57 billion a year on exploration for new capacity that would lock in production over the long term. So fossil fuel companies aren't just meeting demand. They're planning to compete with new renewable capacity for that demand. And that's bad for transition. As Bill McKibben recently put it, we're in a race between a rapidly unraveling climate and a rapid build out of renewable energy. And the relevant time frame is the next 5 or 6 crucial years. Overproducing fossil fuel risks slowing us down in that race. It risks throwing renewable capacity build out off course and leaving renewable capacity underutilized. Another argument that we come across is that restricting investment in the fossil fuel sector would deprive clients of access to potentially attractive returns from the sector. But we think there's an important context to this opportunity cost argument. That context is the asymmetry between the investable size of the fossil fuel sector relative to its impact on climate change. And to sort of illustrate this point, the MSCI World Energy Index has a market cap of around $2.9 trillion. That's less than 5% of the market cap of the parent MSCI World Index. Yet fossil fuels generate around 3/4 of global emissions, according to the WRI. And the risk that overproduction of fossil fuels as the primary cause of emissions pose to the value of a broad portfolio of investments over the long term means that the opportunity cost for the 5% needs to be held in context to the cost of that opportunity for the other 95% of the portfolio. The final argument I'll touch on here is that divestment doesn't work. And there's a few strands to this argument, including that it doesn't change a company's behavior, for instance, through impacting its cost of capital, and also that divesting means losing the opportunity to influence the company. And the first point we'd make is that we don't see divestment as being primarily about engineering outcomes in the price of a company's securities. It's rather about removing portfolio exposure to companies whose strategies pose elevated long-term risks for the portfolio overall. Divesting allows reallocation of capital to companies whose strategies better align with clients' long-term interest, and indeed rewards that alignment. On the strand relating to the loss of the opportunity to influence, well, we'd simply say that influence only has value if it has the realistic potential to achieve outcomes. In this case, to persuade fossil fuel companies onto a different path. Right now, we'd conclude that the failure of the sector to align or move at any kind of reasonable speed towards aligning suggests that that influence is not proving effective. Attaching consequence to that influence through escalation tools and the realistic possibility of reallocating capital elsewhere is likely to enhance the effectiveness of the investor voice, in our view. So we believe that a more purposeful approach is urgently needed from investors, starting with a selective investment approach, which we shape through 4 vectors. So firstly, the asset class. Debt plays a different role from equity because it has to be repaid. We calculate that the fossil fuel sector currently has nearly $1.9 trillion of debt outstanding. Over time, fossil fuel companies will have to approach investors to refinance that debt. That gives debt investors significant potential influence by making their participation in debt refinancing contingent on expectations of alignment. As a result, we place stronger restrictions on debt financing than on equity exposure. Secondly, the fund type. Essentially, all portfolios are exposed to the economic effects of climate change over the long term, and so all portfolios should adopt policies for the fossil fuel sector that mitigate the risks of climate change to the portfolio. But investors in funds labeled sustainable, responsible, Paris-aligned, etc., have a higher expectation of transition alignment and require stronger restrictions. Third is the fossil fuel type. All fossil fuels produce emissions, and all fossil fuel production therefore has to reduce. But on average, coal has a greater intensity of emissions per unit of energy, while unconventional oil and gas carry additional environmental and/or social harms. And so we place stronger restrictions on these. And finally, while the sector overall is failing to align to transition, as Maeve says, some are clearly worse than others. Where an investor believes their client mandate requires some exposure to the fossil fuel sector, they should actively ensure that capital is narrowly directed to the companies most actively engaging with the need to reduce production, creating a positive momentum that rewards progress towards alignment. And our technical paper sets out a comprehensive investment matrix that reflects prioritization in that selective approach drawn from those 4 vectors. Now, combined with that more selective investment approach is concentrated, intensified engagement with those selected companies. And that engagement should be founded on clear expectations and milestones to align with transition, including reduced production and an end to exploration for new capacity. Investors should apply the consequence of the escalation toolkit, including voting for shareholder resolutions that lean into alignment, voting against standing items to express disapproval for insufficient progress, and moving through to the capital allocation lever of reduced weighting and divestment if progress remains inadequate. Of course, we fully recognize that transitioning the global economy to limit temperature rises is not simply a matter of getting fossil fuel companies to reduce production. Transition is enormously complex and multi-layered, And this paper should form part of a broader investor approach that covers the whole ecosystem of transition. That includes engaging with clients on the risks for transition posed by the current strategies of fossil fuel companies and to ensure mandates are shaped to mitigate those risks. It includes engaging with regulators and policymakers, as Oliver outlined, to ensure that incentives support transition and the need to encourage the scaling up of capital to create a clean economy. It includes engaging with the financiers of fossil fuel activities, including banks and insurers. And it critically includes companies who consume fossil fuel-based products so that they send clear demand signals that they will be prioritizing clean energy and clean feedstocks. But while our report is not intended as the whole solution to delivering transition, we think it's a central component of it. Reducing fossil fuel production this decade necessarily requires the cooperation of fossil fuel producers. It isn't enough to rely on policy or the demand side alone to curb the risk of fossil fuel overproduction. Indeed, by using the full range of their levers of influence over fossil fuel companies, investors can complement and galvanize policy, capital, and the demand side to act. Finally, enhanced transparency on how investors are allocating and stewarding capital to the fossil fuel sector is crucial. Climate is a collective problem, and the economic and environmental risks that come from fossil fuel production are shared. Enhanced transparency will help clients make more informed assessments of how climate risks to their capital are being mitigated. It'll offer clearer sight to fossil fuel companies on the effect their strategic choices will have on their relationship with investors and access to their capital. It'll help policymakers assess how rules and incentives need to be framed to be a proper tailwind for transition away from fossil fuels. And so in conclusion, transition's underway. COP28 signaled the beginning of the end for fossil fuels. But timing is critical. If the fossil fuel sector competes with transition and slows it down, that is bad for the environment and bad for the global economy upon which financial assets depend. Investors have the potential to influence fossil fuel companies through a playbook of a radically more selective investment approach, concentrated engagement, influencing the ecosystem, and enhanced disclosure. And with that, I'll turn back to Louise.
Thank you, Neil, and also thank you, Oliver and Maeve, for those really thought-provoking presentations. So I think we're ready now to hand over for some Q&A. So please do feel free to put your questions into the Q&A function in the Zoom. I can see we've got some coming up already. First question, and I wonder if this is the one for Maeve. What should investors look for in an oil and gas company transition plan?
Sure, thanks, Louise. So we've been doing a bit of thinking about this actually recently in terms of what an oil and gas transition plan looks like. And I think oftentimes a transition plan is framed in terms of a climate action plan, really like how do you start doing kind of less of the bad stuff. And I think that's kind of certainly something you should expect from an oil and gas company, especially around their emissions and how they're meeting those. But it's not to be confused with kind of an energy transition response plan. So that's kind of more towards what I was speaking to at the end of my presentation, i.e., what is the company's business strategy, if it has one, to kind of continue operations as the transition unfolds and demand for oil and gas kind of contracts. So I think in terms of what you should look for, one, I think you should discern whether or not you're looking for a climate transition plan or a climate action plan, i.e. how fast they're going to stop doing the bad stuff, as distinct from an energy transition response plan, i.e. what is the company's business strategy given that fossil fuel demand is falling.
Thanks, Maeve. And if I can put another question your way, obviously emission targets, a key metric that investors and lots of interested stakeholders are quite focused on. From your perspective, what's a good Paris-aligned emission target look like?
Yeah, so we've developed what we call our hallmarks of a Paris-aligned emissions target. And I think what's really important to consider. I spoke a lot about how Paris alignment for an oil and gas company requires production to fall. And so I would encourage investors to think of an emissions target, if framed appropriately, can be a proxy for a production plan. So an appropriately framed emissions target would include, a net zero by 2050 target, but also interim targets set to kind of chart the course to net zero by 2050. And those interim targets should be set on an absolute basis, not on an intensity basis. And then the targets themselves should cover kind of the entire suite of a company's emissions, so both their cover assets that they operate, but also those in which they have an equity share. And then follow the kind of full suite of their operations, so be it downstream, midstream, or upstream, downstream, and midstream.
Thank you. And we've got a question that's come in about bank lending, noting the proportion of financing that fossil fuel companies receive direct through bank loans. And the question, did we address this point in the paper? Neil, I don't know if you want to respond to that, but I think, we're focused very much on the asset management sector in this piece. What I would encourage the questioner to do is to take a look at some of the other work that ShareAction has going on in relation to banks. And we published a report last year about decarbonisation and green finance targets in the UK and EU banking sector, and certainly do a lot of work to encourage banks to decarbonise their portfolios. But Neil, I don't know if there's anything you want to add to that. We can certainly share in the follow-up for those interested some links to our wider work on banking. But is there anything you would add at this stage?
Yeah, no, thanks, Louise, and yeah, you basically covered it, and so would very much direct you to our banking team on that. The RISE series of guidance papers that we produce is really to try and take the definition that we came up with for responsible investing last year and sort of help bring it to life through what we think asset managers and their clients should be doing in sort of responsibly stewarding and investing capital. So the RISE series is very much focused at things that asset managers should do in stewardship and investment, but obviously within ShareAction, as Louise has said, banking is a very big focus for us, and we'll put you in touch with that team.
And actually, Neil, I might pass the next question your way, if I can. So we've got a question here about passive fund managers. How we expect them to engage with these recommendations, given they don't have the ability to divest?
Yeah, no, thank you. And it's a very good question, and something we touch on a little bit in the report itself. And we do recognise that the capital allocation lever for passive funds is less dynamic than for active funds, because inclusion rules are essentially preset. Most managers do have a mix of active and passive. So certainly our recommendations would fully apply to whatever portion of their AUM is active. But we also think there is a lot that a passive manager can still do, or a manager can do with its passive funds. So for instance, they can commit to including transparent science-based restrictions on fossil fuel companies in all new products that they create going forward. They can actively create products that embed alignment expectations and market the benefits of those aligned strategies to their clients, particularly in the context of that longer-term economic and financial risks that transition presents to them. They can also engage index providers, particularly to strengthen exclusion criteria for misaligned fossil fuel companies in their thematic climate or sustainable indices, and perhaps to sort of really emphasize those indices over those that perhaps might have less alignment. But I think the other point is that because the capital allocation lever is less dynamic for passive managers, it really puts more emphasis on robust stewardship and the use of escalation tools other than the capital allocation escalation tools.
Absolutely, and I might take this opportunity to give a plug to the second Rise paper in our series, which is all about escalation. Really encourage people to go to the Share Action website for that, and some, I think, really helpful and practical guidance for investors about how you can do escalation in practice. Do keep sending your questions in using the Q&A function. I'm gonna turn a little bit, again, it's a question, I think for you, Neil. What's our Share Action's specific asks of investors in relation to new conventional oil and gas? And how is this different across debt versus equities?
Yeah, thanks, Louise. And so a really good question. And so we think about the asks across sort of three aspects. So one is the investment expectations, one is the engagement and escalation expectations, and one is disclosure. Focusing on investment first of all, and one of the things we've tried to wrestle with this whole paper is strong pushback from asset managers that they can't divest the whole sector. The whole sector is essentially unaligned, as Maeve's rating chart shows. The best is D, and it goes down to H. And so what we're saying is, if an asset manager says they cannot divest the whole sector, their fiduciary duty or their interpretation of mandates requires some exposure. We're saying it should be very narrowly focused towards the least unaligned. In other words, it would be sort of pushing them up towards hopefully A's, B's, and C's in the carbon tracker scale. And we think that sort of circling capital from the worst to the best or the least bad certainly creates a positive momentum that has the potential to impact the whole sector. And so, within that, we are, of course, saying that selective approach means less capital being allocated to the sector overall to reflect its absolute lack of alignment relative to other sectors and the problem that transition means for it as a sector. But within that selective allocation, really prioritize the best. And we think that's less appetite for debt than equity, less appetite in labeled funds than unlabeled funds, and conventional exposed expanders not being penalized quite as hard as unconventional and coal. Through engagement, of course, what we're saying is use the escalation toolkit to encourage those companies off an expansion path, and disclose. So be really transparent about how you're investing in those companies, how you're engaging, what the asks are, what escalation tools you've used, how you voted, etc.
Thank you, Neil. And another question that I think is a really interesting and challenging one for the sector is, how should investors think about mitigating risks that are modelled over the long term into investment decisions that are made today? And again, I think that's probably one I would push towards you, Neil. I don't know if Oliver might also have something to say about the timeframes for modelling risk, but perhaps if I can ask you to start.
Sorry, slow on my unmute button. Yeah, and so I think what we'd say is that just because those losses are modelled a long way into the future, doesn't mean that they'll only manifest at some point in the distant future. We don't know exactly when and how they'll manifest through to asset prices, but you should certainly expect that to sort of ripple through. But also the time frame over which beneficiaries depend on their investments and their pensions is over the long term. So that long-term manifestation of risk and damage matters. But I think the other thing is, and I'm sure Oliver might have more to say on this, but the acceleration of climate effects demands an urgency. Actions taken today have a much greater value than actions postponed until tomorrow in that climate context. And so, we recognize the investment system is structured to incentivize short-term performance, and that is a hurdle to addressing those long-term risks of climate. But we think that's why it's essential asset managers, engage their clients to ensure that mandates reflect and allow for that long-term risk perspective to be embedded as well. But I'm sure, Oliver, you might have some additional thoughts.
It does seem to be true that in the financial sector, people work to 1-year benchmarks, even if they're investing for the long term. And I think it's maybe to do with the fact that the price of financial assets is only what the next person's going to pay for it. So you're always one step removed from reality in that sense. But so markets don't move in straight lines. They sort of tend to be periods of stability and then sudden changes. And the classic example, there's plenty of examples of that, but classic example is the financial crisis in 2008. And I think what tends to happen is the asset managers think that they can, if it's going to happen more than 1 year in the future, that they can get out in time before everyone else. And everyone thinks they're better than average, right? But of course, that can't possibly be true. So that's something to bear in mind for any asset manager when you're modeling the risk, is thinking about the risk of sudden changes in asset prices.
Yeah, if I can add to that, completely agree with Oliver and Neil. One thing I would say is that we often speak to investors and they ask us, well, when will the tipping point come? When is this demand destruction going to be reflected in oil and gas asset prices? And if I could answer that, I wouldn't be sitting here. But what I would say is that it's not even necessarily that it needs to get to that point. We need to get to the point that the market or the idea permeates both the investment community and the markets that point is going to come. Because markets are based off expectations of future returns, so you don't necessarily need to get to the tipping point. You need to get to a place where it's recognized that the tipping point is coming, and I think that point in time is a lot closer than we may think.
Thank you. And we're really close to time, but I want to try really cheekily to squeeze in one more question, because I think it's a really important one that wraps things up, and perhaps I might ask Oliver to answer it. We've talked about in a number of places the role of governments. Oliver, what's the best thing that governments could do to support this transition?
Okay, I'll have a go. So I think the first thing is to treat climate change as a risk problem, in line with other risk problems, and then look at the magnitude of it, which is probably greater than, or it's much greater than the current policies are really dealing with, and then look at the full range of policy responses. So the current orthodoxy in economics is that you want a carbon price, a carbon tax. That's part of the solution, but you also should be looking at subsidies and regulations much more than is currently done. Look at what's happened in the UK offshore wind, for example. Look at what actually already worked. UK offshore wind is a massive success story, sort of by accident, but there were enough subsidies in the initial stage to get the industry to a point where it doesn't need subsidy anymore. It's a massive success story. So that's sort of intervening in the system. And the general point is understanding the economy as a complex system. Look at, for example, the work of Doan Farmer at Oxford University, who's worked out that actually there's a net saving from a faster energy transition, even regardless of climate change. So if you add up the costs and benefits. So those are my suggestions.
And that point on net saving, I think, is a really great one to end us on. And I'm really sorry to have brought us to time. So it just remains for me to thank you all very much for joining us. We really do appreciate you giving your time. A huge thank you to our speakers, Oliver, Maeve and Neil, for your really thought-provoking contributions today. I leave on the slide some actions that we would encourage people to take away for asset managers and asset owners to think about how we can move to the next step here. We would really like this to be the start of a conversation. We're trying to contribute to the debate by bringing some practical and implementable ideas to the table. So really keen to hear your reactions and thoughts. So please do spread the word and do be in touch. We'd be delighted to hear from you. As I say, it just remains for me to say thank you. We will follow up on email, and I hope you will have a wonderful afternoon. Goodbye. Thank you.